Welcome to TradeStation, your place to claim your financial edge. Today, we'll be diving into the basics of investing and the stock market. In this three-part series, we'll be covering 101-level explainers on how to get started investing in the stock market. Let's begin with a basic definition. Investing is the act of buying securities or tangible assets in an effort to achieve capital gains, income, or both. Investing is a means to an end, and that end is the achievement of your financial goals. The first thing to do when investing is determine the time frame for your goals. There are three types of financial goals: short-term, intermediate-term, and long-term. Short-term goals are those that need funding in fewer than 2 years. Examples include saving money to go on vacation or buy a car. Intermediate-term goals are ones you want to achieve between 2 and 5 years from now. These might include saving enough to buy a new home or adding an addition to your current house. Long-term goals will take 5 years or more to achieve. Examples include saving to buy a second home, fund your children's education costs, prepare for retirement, or achieve financial independence. One way to save for your financial goals is to invest in stocks. Stocks, also known as equities, are a popular way to build wealth. They're a common part of many investors' portfolios, or their collection of investment vehicles like stocks, bonds, cash, real estate, etc. Buying stocks means you become a partial owner of a public company. A public company can be listed on a stock exchange, which makes it available to all investors. Short-term investment goals typically do not include stocks. While the long-term trend of stocks is to move higher in price, over the short term, the stock market can be volatile. This means stock prices can fluctuate dramatically, both up and down. Many forces can impact the stock market, including political and economic events, the news cycle, and seasonal trends like the holidays. Many of these events are unpredictable. The longer you hold stocks, the more time you have to recover from stock market fluctuations. While there are no guarantees that individual stocks will be higher in 10 years, over the past 80 years, the broader stock market, including indices such as the Standard & Poor S&P 500, has tended to go up over time. However, if you need money for your child's college tuition in 2 years, stocks might experience a significant downturn just when you need the funds. That would leave you with less than you need. The second thing to do before you begin building a portfolio of stocks is determine your risk tolerance. Risk is the potential to lose money. If you buy certificates of deposit, known as CDs, at your bank, you are guaranteed to get your principal investment back when the certificate matures. Maturity is the date the certificate expires and ceases to pay any more interest. Because you get all your money back, this is a no-risk investment. If you purchase baseball cards, on the other hand, with the hope of selling them in the future at a higher price, you have a high potential of losing all the money that you've spent. This is a high-risk speculation. Risk on the stock market isn't so cut and dry. Every stock has a different risk profile because it represents a different company. For example, purchasing stock in a well-known manufacturer, like a company with a history of good management and sells products everyone needs to buy on a regular basis, is generally considered a low to medium risk investment. Purchasing stocks in a biotechnology startup, on the other hand, may be a higher risk investment. This is because the process of creating drugs takes years, and many tests need to be passed before the products can be sold on the market. Determining how much risk you personally can handle is called measuring your risk tolerance. Your risk tolerance is the amount of risk you can take on and still be able to sleep at night if your investment's price falls. If you purchase shares in a risky company and the share price falls 30%, will you still be able to sleep through the night, or will the stress make you anxious? If you're unbothered by the idea of losing that money, you may have a higher tolerance for risk. If you're anxious at the very idea of it, then you likely have a lower tolerance. Understanding your goals and your own risk tolerance are the first foundations you'll need before you begin investing in the stock market. In subsequent videos, we'll explore the basics of how the market works and the specific steps you can take to begin your investment journey. Now that you have a basic understanding of the time frame for your financial goals and your personal risk tolerance, you have the information you need to research investment vehicles that suit your goals and lifestyle. Learn more by subscribing to our YouTube channels and visiting the TradeStation website.